What's going on, guys? We are doing another video on the stock market, and a thought that comes along with the absolute bullish market that we've been having over the past couple of years. The market has just been going up and up and up, and it seems like there's no end. Is Are the stock prices too high? Should I be investing now, or should I wait until the market kind of corrects itself or becomes a little bearish and stocks become cheaper? Well, a lot of people are impatient and they want to buy stocks right now because they feel they have the capital. They don't feel like waiting. They feel like you're market timing, and that's not the smart thing to do if you're an investor. While others feel like you have to wait and pick your spots, get value investments. So, what is my take? Well, I do believe that the market will correct itself. If anyone tells you that they know when it's going to correct itself, they're full of it. Nobody knows when the market will correct itself. It will happen eventually. The market has been going up way too fast over the past decade for it not to have at least a little correction. We saw a little correction back at the end of 2016. It wasn't major, but there was a little correction. It made stocks a little bit more of a discounted price, and then it continued its bullish ways. I think you'll see something like that eventually, probably in the next couple of years, in my personal opinion, but no one can predict it. But I think it will correct itself. So I do think that stocks are a little inflated. So what do you do if you are hell-bent on investing right now? You don't care what the prices of the stocks are if you like a stock that much. What are some things to look for? Well, in times like this, I would say you better be getting your money's worth. And for me, the way to predict whether you're getting your money's worth or not is to look at the balance sheet and see how strong the balance sheet is. And the reason for this is because I believe that if you look at the balance sheet, you'll be able to see whether or not a company is going to weather the storm of a correction or a mini depression well, or if they're going to have to panic. So I always look at the balance sheet. So in yesterday's video, I was talking about Ford a lot. So if we get out of the Robinhood app and we go to Yahoo Finance, so I pulled up the ticker for Ford already. I was talking about it a lot yesterday. So let's look at their balance sheet. So if we go to financials, you see their income statement. Let's look at the balance sheet. So one thing that you should immediately look for is if the company has cash on hand. So if I can just find the marker here, cash on hand, cash and cash equivalents. So these numbers are all in thousands. So as of December 31st of 2016, you can see that on hand Ford had 15.9 billion in cash, which is very liquid. They can do whatever they want. So that's a lot of cash. So they hold a lot up front. Another thing you want to look for is how much assets they have in terms of compared to how much debt they have. So if you're looking down here at the liability side of the balance sheet, you can see that they do have a significant amount of debt. So if we look at short-term and long-term debt here, we're talking 49 billion and 93 billion. So that comes out to about a total of a roughly 140 billion in debt. So if we scroll back up here, we have 140 billion in debt, and you see their total assets in bold right above the liabilities at the end of the assets. So their total assets is 237 billion. So not quite a 2-to-1 ratio. And I think the massive amount of debt that Ford does have does leave them. That's why their stock is a little lower than you would expect for someone who has such great revenue and income numbers and such a massive market cap. So they have 237 to 140 billion in assets versus debt. But they do hold a lot of cash, which is a good sign for surviving any kind of market corrections or downfalls. And they also have a lot of receivables. So if you're looking here, they have over 57 billion in receivables coming into their company. They also, if all hell breaks loose, they do have some property and land that they could sell off. That's over 60 billion in property, plant, and equipment they could sell off if they wanted to. But as you can see, over the past 3 years, from 14, 15, and 16, they've been steadily increasing the amount of property, plants, and equipment that they do have. Also, their number of long-term investments has shot way up since 2014, which is all a good sign. It means the company is looking to grow, and they're continuing to enhance their operations to show that they're going to grow. So that's Ford. So let's look at one of their competitors, and I'll show you a great example of a great stock that could survive pretty much any market. Well, it most likely will go down a little bit, but it can definitely ride the waves of the market. So we're looking at Chevy, Ford's competitor. So their stock price is $128, way higher than Ford's. It's almost 10 times higher, roughly. If we look at that, their chart since inception, since January of 1970, you can see their stock has been growing quite rapidly and at a really good pace. But if we look at their financials like we were looking at Ford, and we go over to their balance sheet, now one thing you might notice is that they actually held less cash than Ford, which is surprising considering that it should be a bigger company. However, once you get down to it, their debt is very minimal for how big of a company there is. So if we look down here and we circle the debt, short-term debt, long-term debt, 35 billion and 10 billion, you're coming out to 45.5 billion in debt. So if we mark it here, 45 billion in debt, you're looking at their assets of 260 billion. That is a phenomenal ratio. They are looking very strong. They have a very strong balance sheet. Their assets highly outweigh the debt that they owe. They have a ton of property, plant, and equipment. They have a lot of receivables. Their cash, despite lower than Ford's, it is really high. The fact that they have $6.9 billion in cash that they can do whatever they want with at any given time is definitely a plus to look for investments. And not all of their assets are reliant in goodwill. If you see a big, enormous, inflated goodwill number, it is cause for hesitation, because if their assets are large part of it is coming from goodwill, which is something that you really can't sell really quick or have liquidity in. It could be a warning sign if they don't have much cash or property to sell. Goodwill is essentially useless because the company is going down anyway, and the goodwill will get impaired, and the value of the entire company will go down, and pretty much everything shoots down with it. So Chevy, in my opinion, is actually a little bit better than Ford in terms of surviving the market, because they have very little debt compared to their assets, and they have very good assets. They have plenty of cash and plenty of receivables to outweigh the short-term and long-term debt that they have. Guys, if you enjoyed this video, please subscribe, like it, a comment if you like. If you have any videos that you want me to do a topic of, just let me know in the comments. I'll be glad to do one. If you are new into investing and you want to get into Robinhood, which offers free commission trading, you can use my referral link down below in the description, where if you sign up, you don't have to deposit money or anything. You don't have to link your bank account or anything. But if you sign up using my link, you will get a free share of stock. I will get a free share of stock. You'll be helping the channel, and your portfolio will be off to a good start. I hope you enjoyed this video, and I'll see you in the next one. Thank you.